Salesforce Inc. has been one of the fastest growth stocks of the modern era. As you can see here, since the company went public back in 2004, the company has grown earnings at over 50.86% per annum. What's really incredible when you look at this awesome historical record, when you put the price on the graph, you can see that the price has tracked the earnings growth, and the stock appears to be significantly undervalued today based on this historical performance. But is it? Hello, everybody. This is Chuck Carnival, co-founder of FastGraphs, the fundamentals analyzer software tool, bringing you another Subscriber Request Tuesday. And a little bit later in the presentation here, I'll get back to Salesforce.com and answer the question, is it actually undervalued today or not? But what I'd like to do is go ahead and talk about 20 other stocks in addition to Salesforce that you guys have requested. Now, when I'm doing a subscriber request series like this, number one is the first thing you need to understand is these are not stocks that I have personally picked. These are stocks that you have picked. These are stocks that you, the subscriber to our YouTube channel, our FastGraphs YouTube channel, want to see. So I'm going to go through these 21 stocks here and determine whether or not, try to help you determine whether or not these stocks are buy, sells, or hold, so that you can look at them. And in the process of doing that, I'm going to introduce a new feature that we've just uploaded into FastGraphs for those of you who are subscribers. And also, I'm going to show subscribers how to use the tool maybe a little more effectively, because we're finding a lot of subscribers are not getting the full benefit out of FastGraphs that they should. So let's start by looking at the 21 stocks that you guys have requested. And what I've done is I've put it in alphabetical order here. So I'm going to go through these in alphabetical order and look at the various metrics of all these companies that you're interested in. As I go through this process with you, try to show you how to use the FastGraphs fundamental research tool correctly. Okay, let's start in alphabetical order here. I'm going to go ahead and move this back to LI Financial. This was the first one that you asked for. Now, LI Financial is a very interesting company. I want you to note that they had, relatively consistent but flat growth, after a very big year starting out. So the first thing you've got to do, when you've got a 228% growth rate here, you get a really anomalous number. So you want to call that out of the equation here. And now you've got the company growing at about 16% a year. But you've got another anomalous number here coming out of the flash crash of COVID. This is the COVID recession, if you will. You can see that the company's earnings surged over 184%. And that actually got a lot of, price enthusiasm, if you will, for the stock. But now looking at forecasts, it's expected to have a down year this fiscal year, which, by the way, has a December fiscal year, and then kind of flat earnings going forward. So we've kind of got almost a reset here. The company does yield 2.74%, and based on this historical record, looks very undervalued. Performance-wise, I also want to introduce you to what we've added in performance. There was a lot of confusion because if you go into the settings tabs of FastGraphs, by the way, or you can, set these graphs up for different things. One of the things we were doing was using different types of dividend dates, X date, record date, paid date, and people were getting some crazy dividend numbers, they thought, because they weren't really looking at them like they should. So now we've expanded the dividend portion of the performance record. So for companies that have dividends, we list each quarter's dividends and then total them up for you, and then give you what the yield on cost per annum was, and then, give you the full performance of the stock. So we got more clarity going on in the performance section. So let's go back to the historical. You can see that the company, LI Financial, has increased their dividend every year. If I go back to this performance report, the average growth of that dividend has been 47.8% per annum. But it's also been a bit of a misnomer, because you have 150% growth after the first year they instituted a dividend. So this is an analytical tool. So what you want to do is you want to call that stuff again out. So, the first dividend, with such a high dividend, a high growth rate, you get this 150% number. So if you're analyzing the stock and trying to get a more realistic approach, if you wanted to look at it from dividend growth, you'd want to get rid of that anomalous year and then look at the normal years. Now, it was a 40% growth in 2018. From 2017, it was 21%. from 56 cents to 68 cents, then it dropped to 11% and back up to 15.79. So that gives you a little more what I'll call realistic look at what their dividend record is. You have the dynamic nature of this tool. Use all the analytical horsepower at your disposal. Now, the key is, though, looking at these historical graphs, you can learn an awful lot about the company, what its operations have looked like. You've got to look at your numbers. Always don't just look at the picture, also attach the numbers to the picture. But here's the key. You can learn from the past, but as they admonished us so many times in the financial services industry, the past is not necessarily indicative of the future. If you're going to make an investment, you always want to look to the future graph. Now, here's what you've got with, LI Financial. Now, going back to that future, I can see that the company has traded at around 9.5 to 10 times earnings historically since it's been in business. So I would use the normal multiple graph as a more conservative common sense graph, and the 5-year normal PE ratio that the market has applied to LI Financial has been 8.89 times earnings. So this blue line represents a PE ratio of 8.89. You can see it's the dark blue column there. The PE is 8.89. Now, the logic here would be if this company gets back to an 8.89 PE, the current blended PE is only 5.25. That's extremely inexpensive. The stock yields 2.75% roughly almost. So you've got a nice, attractive situation here. You've got a good margin of safety, but there's actually no growth expected for this company going forward. Now, the number is negative 2.19%, but again, let's analyze that. That's a combination of a negative 10% earnings growth expected this year, followed by 2.7 and 1.26. So it averages out at about minus 2.19. But really, from a standpoint of practicality, it's going to earn money, but the growth is going to be a little bit subdued. You're actually going to have a negative 2% growth from the last actual that they reported. However, the stock is so inexpensive that if it does get back to this 9 times earnings and these estimates turn out to be correct, you've got a 21%, 22% almost annualized rate of return potential out for the next couple of years using a very conservative multiple or reversion. I call this natural leverage when the PE would expand from 5 to, slightly under 9. That's almost a doubling of the PE. Even though there's no growth, you can still get a decent rate of return and maybe some even decent income and income growth here. So this is what LI Financial looks like. Don't be misled by, just what the picture shows. So the next stock I'm going to look at, going on down the list, and I'm going to start going a little quicker, is A.O. Smith. A.O. Smith is really a superb company. I want you to notice that the growth rate's been about 15.6%. They did have a couple of down years during COVID. They actually performed in a stellar way during the recession of 08 and 09. Dividend record has been extremely good. If you look at their dividend record, they've increased the dividend, every year by a rate of over 13% per annum. So that's something that's really in favor of this stock. You can see that the price has tracked its earnings, but it did go through this period where we had irrational exuberance, in my opinion, where the market's been high. COVID came along and it corrected that temporarily a couple of times where you had 2 down years of earnings, but they were temporary. But even when their earnings went down, the company did raise their dividend. I want you to notice that. And the stock recovered very, very quickly. And now we've had a down year again since the beginning of this calendar year in this little slight recession or correction we've been going on in the market. So it's trading back at its more normal PE ratio for modern times. But I want you to note historically, it's also traded at that 15.6 PE ratio, which has been the growth rate of the company. That's a PE equals growth rate valuation line. So somewhere between this orange and blue line, I think you would want to call valuation. So right now you would argue it's at the high end of valuation. If you looked at it from a forecasting point of view, it's expected to grow at about 11.17% for the next couple of years. So if I put the normal multiple in here, which is high, the stock does look undervalued. But keep in mind, it even does have a margin of safety, but that's giving it a 25 PE that the market has historically applied to the stock. Theoretically, based on, the type of 11% growth we got going forward, this, theoretically, most companies would trade around 15 times earnings. So you've got those two things to contend with. you have to ask yourself the question that, historically a 15 multiple was realistic for this company. It's only been the last 6 or 7 years where we've had these very high valuations, but these high valuations have also created a lot of volatility and, in my view, a lot of risk. My own view, I would look at this as a 15 multiple company, and I would consider it overpriced today, even though we've had this strong correction. So anyway, that's A.O. Smith. Superb company, though. It's really an extremely high-quality company. It's in building products, and, of course, that industry has been exceptionally hot. But, with interest rates rising, that's something that you'd have to be taken into consideration. Now, this is another one that I really like showing, Broadcom, symbol AVGO, because, again, you have to use the tool. Now, the growth rate of the company's averaged over 31.8%. going back since inception. However, you had a 232% year in 2010. Then the growth rate, was more normal. So the first thing I would do is let's get rid of 1 year. Now the growth rate's down to 23%, which is still very attractive. And the market has applied about a 14 or 15 multiple. Even though the actual precise calculation is 14.36, I always try to suggest to subscribers, think of these as a range of value. Think of this as the midpoint of that range. So this would be somewhere between 13 and 15 times earnings would be considered normal. Now, I still have, some, pretty aggressive growth rate in there. But the point is, based on a normal PE of around 14 or 15, if I go to the forecasting graph, it applies a 15 PE ratio. If I use the normal multiple graph, it's a 15.2 PE ratio. The company does look moderately, well, I don't even want to call it overpriced here. I would call this fully priced. This is your valuation corridor, these orange lines here. And it's just outside of the upper end of high value. So, it's not a cheap stock is what I'm trying to say. It's a great company. I happen to be long this stock, but I bought it when it was trading below the blue line. I do want to make that clear. And I'm still holding it because although I consider it fully valued today, I don't consider it risky enough to sell because I do believe that, we've got an opportunity to still make money in this stock, and I do have a low cost basis. But I don't think this is a great entry point today, just based on what you see here, given that the market, wants to apply a more normal 14 or 15 times earnings PE ratio. And again, you can use it. What the beauty of fast graphs, you can manipulate these time frames and look at different years. Here, since going back to the beginning of 2015. Now, this has a October fiscal year, I also want you to note. So the diamonds, the triangles are fiscal year, but the actual lines are the calendar year. So this looks like it's a little overvalued based on, historical norms of a normal 14 or 15 PE ratio. The growth has accelerated somewhat. But again, you want to make this decision with your eyes wide open when you're looking at this stock and looking at it from a forecasting point of view and looking at it from a normal multiple point of view of around a 15-ish, multiple on the stock. It would look fully valued here, but it's a great company. Long-term growth of this company is expected to be 15%, so you'd still probably be able to generate double-digit returns. This is what I was referring to earlier if you held on to this company. This is just a trend line forecast here. These aren't actual numbers for each of these years. This is just approximately how fast the company grows. Now, as a user of the tool, you can also check other sites like Yahoo. We give you estimates. You can go into several others, and the Yahoo long-term estimate is 14.74% on Broadcom as well. Here's 14.8. I'll call that exactly the same number. So the Reuters guys that are, giving forecasts to Yahoo and the FactSet guys that are giving forecasts to us are pretty much in agreement on the long-term forecast. I do want you also to note that earnings estimates have been rising on this company. So that's something else to take into consideration. I don't consider it massively overvalued. I don't consider it extremely cheap. I consider it fully valued and on the upper end of high value. So anyway, that's AVGO that a lot of you asked for, Broadcom. I really like the business. I think it's a little bit pricey. Here's the Barnes Group. Barnes Group is industrial machinery, somewhat of a cyclical stock. notice this relationship between earnings and price. The fundamentals of the company really have a great deal to do with how well the company does. And when the market gets, rationally exuberant, the correction process is almost inevitable. You can see it happening every time. And when the market gets overly pessimistic, the stock tends to correct. And it always tends to overshoot those lines. But this stock is moving into fair value. From the standpoint of looking forward, if I look at the forward forecast, it's expected to grow at about 18% a year. That's applying a fair value PE of 18.63, which is the growth expectation. I would call this one attractively valued with good upside potential, at least for the next couple of years. The normal multiple has also been about 21. You can see that the market has had a penchant for applying a high value to the stock. So you could make a very strong argument that the Barnes Group Inc. at a 1.79% dividend yield, with a growth rate of over 18% a year, would be attractively valued at today's prices. So that's the Barnes Group. But take into consideration the type of company you're investing in, and note that they did cut their dividend coming out of the Great Recession if the dividend is important to you as an investor. Carnival Corp is really interesting to look at because how do you analyze this? You can see the company's been very inconsistent. They had a great dividend record for a while. The stock got really crazy valued before the Great Recession came. Then it collapsed. They cut their dividend. The earnings were horrible for several years. Then they really started to get their mojo back. And then, of course, along came COVID and they shut them down. And now we're looking at recovery going forward. Possibly out there 2 or 3 years, this stock might get its mojo back. In other words, it might be an attractive speculation today, but it'd be a very difficult stock for me to be purchasing, because of everything that's going on in the industry and the company, the COVID lingering effects of that and so on and so forth. But again, use the tool to analyze the business here and recognize some of the characteristics of the company historically, and then try to do your best to make a forecast going forward. Now, I covered Salesforce in the intro. Salesforce had this great growth rate of 50%, but I want you to notice something here. I'm going to take this normal PE line off the graph so I can get a little more clarity. This company came out, it was trading at about 538 times earnings. Like a lot of IPOs, it really looked attractive. And what's happened is we really got some massive PE ratio contraction, if you will. But yet this stock continued to sell at 100 multiple. It's currently trading at a 39 multiple today, and it looks undervalued here. Now, the stock has generated about a 24% annualized rate of return historically. Like I said in the past, you can't overpay for growth stocks with the caveat that as long as you're willing to hold them for the long run and the company continues to grow. So the stock looks, based on its historical record, it looks undervalued today. But again, you can learn from the past, you can analyze the past, but you can only invest in the future. Now, note something here as I go through this. This 50.86% growth rate, if I just shorten it to 20 years, all of a sudden shrinks to 35%. They'll go to lock another 5 years off. Now the growth rate's 28.8%. I'll knock another 5 years off. Now the growth rate is 29, so it's stabilizing a little. I go down here to the next 5 years, and now the growth rate's 18.67. The company is now becoming big, $185 billion market cap. So when I go into forecasting, the company's still expected to grow at almost, we'll say, close to 15% a year. The long-term growth is expected to be even better at around 20% a year. But you have to understand that the stock is trading at a very high multiple relative to that future growth. Okay, now, is it a bad investment today? I'll let you decide on that. The stock has been correcting. The normal multiple is 60.8. That's an earnings yield. The earnings yield is under 2% today at a PE ratio of 39. So a PE ratio of 60 gives you an earnings yield of less than 1% a year probably. The only way this stock is going to make you money is if it trades at this 60 multiple. I really don't consider that to be realistic. More realistic would be it starts to trade at around a 15 multiple because of the 14% growth. But even if I gave it a 20 multiple, figuring that the company would, live on its record, I still have a negative rate of return of about 5.78% exposed going out to the next 2 to 3 years or so. So I love this company. It's been a great company. The market is beginning to bring us some opportunity, but I believe it still has a ways to go before it's actually a purchase. The next stock here is Crocs. Now, I want to make some points. This is a pure growth stock, no dividend. Well, it's potentially a pure growth stock. It had tremendous growth when it first came out, hit the recession of 08 and 09. Earnings completely collapsed. Then the stock started to recover again with good earnings. Then the earnings went into another, long extended decrease here for a period of time. And then starting in 2016 and 17, the company started making money, and it really got to be very faddish and popular again, and the stock price followed the earnings growth. But again, you got no dividends here to bail you out. Now, when you're looking at forecasting, it's expected to grow at about 16% a year. You can buy it at 8 times earnings. As a growth stock, I would consider this a very excellent speculation. Its normal PE has been about 25 for the last 5 years, or 6-year normal PE. So you do have an opportunity to make some pretty good money here. But the question is, the popularity of this stock has obviously weakened over the last 6 months or years. Now, this company trades at a calendar fiscal year of December. So, it is expected to grow about 20% next year, 20.7 and 20% the following year, and then slow down to 7%. So Crocs, for those of you who are looking for a good growth stock, could be a very interesting stock. It's still only about a $4 billion company, $4.5 billion. But, consider the fact that the stock's record is a little suspect, if you will. And, that's when you check things like analyst scorecards, you'll notice that analysts get this one wrong a lot. Not only is it in the, footwear industry, which is obviously a very tough industry in its own right, it tends to be, from a popularity point of view, it comes in and out of fashion. Dominos Pizza is another really great growth story. The company's had tremendous earnings growth historically over the years. Now, I've got some anomalous data here. So to get me the growth rate, I've got to call this number out. I'd get about 14.85% growth, but the company's trading at 27 PEs. It has corrected rather dramatically. Again, I used the tool. I shortened the time frame. It's been given a premium PE of around 32. That's only a 3% earnings yield. I consider that a high price to pay, even for a quality company like Domino's Pizza. Looking at it, forecast is still expected to grow at double-digit 10% rates. Long-term growth is expected to be about 12.8 or 9%. I just think the stock is expensive, but if I use the normal multiple, then it doesn't look so expensive. But again, I've got to be willing to say I'm willing to pay 30 times earnings for this company growing about 15 to 20% a year. I personally won't do it. I'm looking for it to be on the orange line, but to be realistic about it, and to be, it used to trade at 15 times earnings, type numbers back here, even lower PE ratios. They did, institute a dividend. They originally cut it, but then, if you just look at the dividend record here, for the last several years, the company's dividend record has been pretty good. Yields about 1%. Market likes to apply a premium PE. I know that. I see that. Question is, am I willing to pay that? My own view is no, but you'd make your own choice. Foot Locker has been a very interesting stock here recently. The reality of it is, look how the price just tracks the earnings of the company. The key is when you're buying stocks, if you're a long-term investor, you're buying the business and you're buying a participation as a shareholder partner in the business. So the earnings matter a lot. Now, this got caught up in COVID where they, work in a lot of malls. They closed the malls. The stock suffered, then they recovered. And now, there's questions on what their future with Nike is going to be like because Nike's starting to want to do their own online stuff. The stock has fallen dramatically in value. You can buy it today with over a 5% yield. That's very, very attractive for a company like Foot Locker. Expected to actually have negative growth this year, significant negative growth of about 40% before it starts to grow again. Long-term growth rate is, also expected to be nothing. I'll check with Yahoo to see if they have a more sanguine or positive look. And Yahoo is saying that the next 5 years, they think it might grow at 35% a year. So, that's a positive. This company could be getting its growth rate back. Really hard to figure. The only thing I will say about Foot Locker, it's extremely inexpensive today. And I would call this a very interesting speculation. Flowers industry, no dividend, semi-cyclical company. For the last decade or so, it's been a pretty good grower at 17% a year. Earnings have fallen pretty precipitously. Quarter after quarter has a June fiscal year. It's come down to where, it's gotten reasonably inexpensive. Based on that cyclicality, it's expected to start growing again after this year at double-digit rates. This could be very attractive as a growth stock, going forward if you're willing to take the speculation. Long-term growth expected to be about 21% a year. But again, know what you're looking at, know what the animal that you're investing in looks like. FastGraphs isn't dictating valuation, it's revealing it. It's allowing you to analyze the data and be able to make decisions for yourself. The next stock that I want to look at is Iamgold. I personally don't like commodity stocks, and this is a good example why. It's cheap, $3.41 a share. PE is extremely high because the E has disappeared. I want to make that clear. You can see it's had very erratic earnings here. It's forecast to maybe have some growth going forward. Very, very difficult stock to own. They've eliminated the dividend. You can see that, the fundamentals of the company have dictated what the price has done. This is just not my cup of tea. And, I would suggest that it's also very expensive today relative to what might happen. But you're dealing with rising interest rates. You want to speculate in a gold stock. That's what you'd be doing, I think, in that company. Leggett Platt, tremendous company, tremendous dividend record. It had dividend growth of over 6% a year, but very consistent. I think I want to make that clear. You can buy the stock at a 4.68% record. Notice that the dividend has been much more consistent than the earnings and certainly more consistent than the price volatility, but the price has now fallen into fair value territory. I think you can buy Leggett Platt with a minimal or a moderate, margin of safety. The stock does offer double-digit 15 to 20% rates of return out for the next couple of years. Long-term growth rate, no one's willing to make an estimate because I think of the cyclical nature, but the next couple of years look like, decent growth of 6 or 7% going forward with a 5% dividend yield. Very high quality company, moderate debt at 49%, below 50% debt to equity. So those of you looking for income, I think Leggett Platt would be a good choice, but not necessarily a high return. Micron, very cyclical semiconductor, as you can see. Earnings, are very unpredictable. You can see that in the analyst scorecard. Very difficult to forecast this company because of the nature of the beast. The only thing going for it at this point not the only thing, but one of the things going for it would be it's expected to grow, with chip shortages and everything else going on. And again, you have to do your own research, but it is expected to grow. The long-term growth rate is expected to be extremely high. So this could be, for those of you who like growth stocks, this could be a very attractive opportunity to buy a very fast-growing company, but beware of the cyclicality. Just beware of the fact that, at times the stock gets very, very inexpensive. NRG Energy, just earnings all over the place. Dividend all over the place. It's forecast to have a really horrible year this year, followed by some good years. I think this is a very unpredictable, unreliable company, but I do think it's inexpensive today. So you might want to, take a closer look. Nexstar Media is a growth stock, but it's kind of inconsistent. So you got to kind of shorten the time frame here and look at just the last period of time. Forecast that's expected to even have very cyclical earnings growth going forward, but the stock is very inexpensive at 8 times earnings, has over a 12% earnings yield, a 2% dividend yield. This could be a very attractive investment over the next 3 to 5 years or so. Nexstar Media, it's a broadcasting company, but notice that the market has generally, applied a very low multiple to the stock. Now, the last 4 or 5 years, it's gotten better. But historically, I said a low multiple. It's applied an 18 multiple, lower than its growth rate is what I was trying to get at. So it does look like, a decent speculation opportunity, but beware that, this company is going to give you some challenges in terms of what its earnings results and so on are going to be. And of course, any of these stocks, you want to look at their cash flows, you want to look at their sales and everything else. Progressive Software is a software company that has decent growth. They just instituted a dividend a few years ago after rising it, pretty high the first year from 13 to 50 cents. If you look at their performance record, they've been growing the dividend by about 4 or 5% a year since. That's what I think you should expect because the growth rate's being expected to be about 6.7, offers a 1.5% yield, does offer some decent total return with PE ratio expansion and so on. The company normally trades at around a 15 multiple, which is what both forecasting charts essentially are showing. So this would be a very attractive entry point for Progressive Software today. The next one is RCI Hospitality Holdings. I don't know if we're missing data here or what, but this company is very challenging. They were very challenged outside of COVID. One thing about this stock, if you're a prudent type person, this company does get involved in the adult industry somewhat, but they also have a restaurant business that they call Bombshells. I haven't done a lot of research on this stock, but if anything, with no dividend yield or a very low dividend yield right now, it does look very undervalued given the expected growth rate going forward. So this is one that, if you're willing to overlook the business they're in, or that doesn't bother you the business they're in, you might want to take a look. Ross Stores has been a favorite of mine for years and years, had very consistent growth. COVID, I think, needs to be ignored because this is a 100-year event. The company's recovered nicely. The only thing about it is I don't think the company's cheap at these rates. I do expect it to grow pretty consistently at 9 to 12% a year going forward. It historically has tracked its earnings very well. I just think it's a little expensive today, but I think it's a great company, and if the market gives you a chance, you might want to take a closer look. Viatris is the old Mylan Labs. Earnings growth has been really poor. They are instituting a dividend. The thing that this company has going for it right now, it doesn't, it's really hard to analyze this stock. It doesn't have, any real growth rate expected for the next couple of years. The long-term growth rate is not expected to be very high. The only thing this stock really has going for it is, it's trading at less than 3 times earnings, okay? It does offer a very high dividend yield now, but I would call this a speculation, not a sound investment. But if you want to take a look, Walgreens Boots Alliance, I've covered this in the past. I believe this was the opioid crisis issue. I think this stock is very cheap, offers over a 4% dividend yield, isn't expected to grow much. The real opportunity here is the low valuation, I think, regardless of whether you use the normal PE or the theoretical fair value PE. The stock is cheap and does have some good, return potential going forward. So you might want to take, CVS looks attractive also, but Walgreens looks a little better right now. Whirlpool is a moderately cyclical stock, very, very inexpensive, over a 4% dividend yield. It's BBB rated, good, solid company. If I look at it, from some of these other metrics, on the last stock, I really look here. I'm looking to see how well is the dividend being covered. I'm not really looking at price to cash flow as much as I am dividend to cash flow. I think that's the real key. But having said that, Whirlpool looks like it's, really worth taking a look at right now. If you're looking, especially if you're an income investor, looking for for dividend income, it's trading even far below at only 6.5 times earnings. Its normal PE of only about 11 times earnings. So, it's had good stellar performance going forward. The dividend record has been great. Hasn't necessarily outperformed the market, but keep in mind it's extremely undervalued today. And, measuring performance without simultaneously measuring valuation is a job half done. There it is, the stocks you asked me to look at. I wanted to do this and also show you some of the new features of Fast Graph, like the new performance record that gives you some expanded dividend detail. I want to emphasize that you need to use this tool and analyze the numbers that you look at. Just don't look at the picture. Make sure you understand what the numbers are really suggesting and representing to you, and use the tool effectively and use it dynamically, because the dynamic nature allows you to do a much more comprehensive analysis than most tools. Anyway, this has been Chuck Carnival saying thanks for watching. I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel, but also take a hard look at Fast Graphs. It's getting better and better, and we got some really exciting things planned going forward as well. But right now, I think it's one of the more powerful financial fundamental analyzer software tools on the planet. Thanks for watching.